Well, on to our first story. China is passing a new personal data law set to take effect in November 1st, I believe. And just looking at a few details from the reports, let me read this here. China has instructed its tech giants to ensure better secure storage of user data amid public complaints about mismanagement and misuse, which have resulted in user privacy violations. This is a Reuters report here. Akiko, we've been talking about this, the China crackdown on tech. This is maybe a little bit different, but it still is addressing complaints about those big tech giants. What's your take on this?
Yeah, so officially it's known as the Personal Information Protection Law, and the full text of this has not been released yet. But as we understand it through these reports, it is very similar to the data protection laws that are in place in Europe, as known as GDPR, which essentially requires organizations as well as individuals who collect data to ask for basically an okay from the users before using the data and processing that. Now, there's one key carve out here, Jared, because you can say all you want in terms of GDPR setting the precedent and China following. China has a significant carve out here for the government, because if you think about the amount of data that's collected in China, we've talked a lot about the surveillance state. If you've been to China, you know the amount of cameras, the amount of data that's collected. And so in many ways, it feels like this is just the government's way of really cracking down on data collection, but saying, look, we reserve the right to be able to look at that data for the government. That's a key difference. Regardless of how you process it, though, it does point to a significant turnaround in terms of the attitude the government has taken on these tech companies, these big companies who've been collecting incredible amounts of data, which has led to the success of those like an Alibaba, like a Baidu. And a lot of people have pointed to what we heard from Baidu CEO Robin Li back in 2018, who really said that in China, we just take a different approach towards data, that users trade privacy and allow for data collection for convenience and security. The law we're looking at now out of China seems to suggest that there is a significant shift on that front.
Yeah, and we want to continue this discussion. For that, we're going to bring in Kevin Barlow, Miracle Mile Advisors Managing Director. And just thinking about this China situation, I guess you could go back to last fall, 2020, and financial IPO put on hold, effectively canceled by the Chinese government. Looked like Jack Ma might have been in a little trouble there, but things have escalated recently. What's the end game? How do you see this evolving?
Yeah, when you look at Chinese technology stocks, they're down over 60% on the index over the past 6 months since February. And you're beginning to see a spillover effect, not only just into other Chinese equities, but into the overall equity market as a whole. If China is signaling that they are no longer interested in foreign direct investment, that is a major global geopolitical shift and has implications across the entire global economy.
So, Kevin, is there still a case to invest in Chinese equities? I mean, if you look at, a lot of people have looked at Crane Shares, their ETF and KWEB, to see, how significantly these stocks have been hit. It used to be that the concerns were around regulation here in the U.S. Now we're looking at regulation over in China as well. You've got these companies that are squeezed in the middle. What is the case for investing in them?
Yeah, and we began discussing that earlier this year when Jack Ma went missing for a couple of weeks. When one of your top business people and billionaires goes missing, that's an indication that things are changing. So the argument in terms of investing there is simply valuation. That you've seen a 60% drop from the highs in February, and that Chinese technology companies trade at very attractive valuations relative to their U.S. counterparts because of that drop. However, you have to take into account that there's significantly more risk from a regulatory perspective. 5 years ago, everyone was worried about cracking down on Google and Amazon, and the Chinese companies were immune to that. But I think now you'll see that Chinese companies actually have more regulatory risk than U.S. tech companies.
I get a lot of calls from people that look at beaten down stocks and they say, when do I buy? Where's the bottom here? And should investors be dipping their toes in the present time? Is there some kind of signal that you would wait for in the future? Or is there simply no case for owning these shares as a Westerner?
Well, I think that's very hard to determine because that's something you can't look at a spreadsheet or look at an earnings report and determine. It really is a exogenous risk in terms of the leadership's regulatory decisions. And I think for years people thought that there was no situation where China would reject foreign direct investment or the ability to list on foreign exchanges. And you're now seeing that's a major risk factor. So I think that there is a case for investing, but it's buyer beware that Chinese leadership can make a change on a dime, and that the companies there have to follow that, and that's not a similar risk that you'd have when you're investing in U.S. tech companies.
Kevin, let's pull out a bit here and look at the markets broadly. What you're liking right now in the face of concerns around the virus, the questions around timing of tapering with the Fed. What are some specific sectors where you see real opportunity, whether that's in the U.S. or outside?
Yeah, Bridgewater just came out with some really interesting research about there's about 40% of companies that are highly sensitive to what's going on in the economy and about 40% of companies that are highly sensitive to liquidity. And right now, we would be focused on companies that benefit from economic growth rather than those that need excess liquidity. As you begin to see the Federal Reserve begin to taper, look at higher interest rates in the future, but have economic growth of over 6%, old line companies look very attractive. And by old line companies, we like sectors like industrials. We like sectors like finance. We like sectors like tech 1.0. So not the new IPOs and the startups, but the companies that were launched in the 1990s that really now have strong balance sheets and are high quality companies.
So if you go into, you're describing a factor or a style here, which is strong balance sheet. Where do you see the growth trade that had done so well last year, picked up, and has just kind of fizzled out over the last 5 or 6 months here?
So growth stocks have done fantastic, but really they require a lot of liquidity. So as the Federal Reserve begins to pull away the liquidity punch bowl, those are stocks that are going to have a much tougher time. And right now, the top 5 companies really have become more quality companies, but the smaller cap tech companies are all priced to become the next Amazon. And while some of them will be, not all of them will. So we see a lot more risk in small cap and growth in areas like that, and see more opportunity on a risk adjusted basis in areas like industrials, financials, as opposed to the growth trade.
Yeah, and we're definitely going to be keeping a keen eye on that going forward. Kevin Barlow of Miracle Mile Advisors, Managing Director, thank you for joining us here.